Thank you, Virag bhai, for such a kind introduction. So today topic, FEMA, overview of overseas investment, FEMA and tax. So it's a very wide topic, honestly, to cover within 1.5 hours. So before I start the topic, I would want to understand, are people familiar with FEMA provisions or of overseas investment or ever dealt in their practice, so I can pace the presentation accordingly. If anyone has worked on those type of assignments? Okay, we have one. Okay, so we don't have many people over here, so I'll try to keep the pace of the presentation in a manner which is able to comprehend by everyone. Question is, why overseas investment and why this has become such a buzzword now, right? So before even we go what the intention of FEMA etc. is, let's look at some statistic that what really makes now overseas investment a buzzword. Now a lot of HNI clients you may have who have one or other kid going out of India. You will have one or the other client coming by, ki we want to set up a company, say in Dubai, in Singapore for trading, etc. So now these inquiries are very common. And if you look at the graph, the investment which is happening overseas has also significantly increased, right? If you look at 24-25, we are about 43,000. And already 3 months down the line, we are 13,000. If the trend continues, we will surpass even last year. So this really looks into the magnitude of investments that are happening. And we as CA professionals should be aware of what the law is and guide our clients accordingly. Right? We all are very well versed with auditing standards, Income Tax Act, etc. FEMA is a subject where a lot of non-compliances are happening not because of the intention, but because of some lack of awareness and at times lack of clarity under the law, right? So if you have a brief understanding of FEMA, so it was replacing FERA, which was more a draconian law, probably what we are looking at now, PMLA, we are looking at Black Money Act. FEMA was always meant to be more a civil law, a regulatory law, although there have been some amendments recently which dilute that to an extent. But yes, the objective was always to have a regulated foreign exchange, regulated market, right? And RBI is the authority which really is, supervising, monitoring, administering FEMA. When you really look at a FEMA law, I would say it is more like an incomplete law, or I would say it is a law which is not very precisely drafted. See, unlike an Income Tax Act, or if you look even the PMLA or other acts, there is an explanation, there is a proviso, and every comma, the full stop has a meaning, as we saw in the morning session. FEMA is more an intention-based law. And at times, the intention changes with times. And sometimes, the clients are put up at a hold that, okay, when I did a transaction, that was okay, but today it is not okay, because economic developments have changed. And sometimes clients have to bear the brunt of it. And hence I say it is an incomplete law. And when we generally read a law, right, it has to be read a little differently because more emphasis has to be given on the intention of the law rather than really the comma, the full stop, the wordings. So under FEMA, generally the transactions are classified into two: current account transaction and a capital account transaction. Current account transactions are freely permissible unless prohibited, whereas capital account transaction necessarily have to be regulated, prescribed, permitted, without which you cannot really do those transactions. And our topic for the day, overseas investment, is one such example of a capital account transaction which has to explicitly permit certain activities which if not, or if we are doing something which is in contravention, is not permitted. Okay? And unlike income tax, where we have an Income Tax Act, we have income tax rules, and the act keeps on updating, right? So even if you have to look at the position today, if you're looking at the latest Income Tax Act as amended by Finance Act, you know what the law stands today. Unfortunately with FEMA, the notifications are the one or which were the originally prescribed. There have been amendments over a period of time, but the notifications itself have not got amended. So every time you read it, you have to link it through all the notifications and updates which have come by, which often causes some issue when reading FEMA. So what do you really mean by an overseas investment? And the topic coverage that I have taken today, so I have not covered immovable property as a subject. It's more about financial securities, investment, debt. Those are the topic for the day today. So overseas investment would include typically your equity, your debt, your guarantees, and your portfolio investment. And each of this term has a meaning, has a regulation, which we will see through as we go ahead. So which are the governing regulations, notifications, rules that you need to keep in mind when you are going through FEMA, overseas investment? So first is the OI rules, which are prescribed by the central government. Then you have overseas regulations, which are prescribed by RBI, and you have overseas directions, which are given by RBI. So for the same subject matter, you have to refer across 3 different notifications, rules, regulations to really advise your client as to what really the law is. And there's a logic to it. So under FEMA Act, the powers to notify and regulate a capital account transaction other than debt is with central government. However, RBI is vested with the power to administer what central government legislates. Similarly, power to define what a debt instrument is with central government, but power to notify what is permissible, what is not permissible, limits, etc. with RBI, and of course monitoring, reporting is with RBI. And hence we have different rules, regulations and directions. So we already had some law before 22nd August 2022, which was under the old regulation, and we will refer to it more like a old regulation throughout the presentation, so it becomes easier. And there were certain issues in the old regulations. There were a lot of non-clarity in them, which resulted into this present regulations, which by and large have addressed and clarified a lot of positions. Of course, certain ambiguities prevail. So here important is what happens to the old investments that you did under the old law. So they are, grandfather, if I have to put that word. So anything that you have done under the old law will be, and if you are holding it today, will be presumed to be as if it was done as per the new law. Now this looks very obvious that, oh fine, that always has to be the logical end whenever a new legislation is coming into place. However, there are certain issues. Old law permitted certain things which the new law is not permitting. What happens to those? And a classic example is portfolio investment. Now generally whenever we think of a portfolio investment, typically our mind goes into a listed equity, debt, bonds, those type of instruments. However, under the old law, there was also a possibility that if you have invested into a private limited company without a control, very minority stake, it was still a portfolio investment, right? Like something like nowadays people invest a lot of in pre-IPO listings, placements, etc. Right? Under the new law, things have changed, and we will look at it as we come by. But what was the significance? That under the old law, there was hardly any reporting because it was a portfolio investment. Now coming to the new law, this is no longer a portfolio investment. And now when an individual who had invested under the old law is liquidating those investments, wanting to credit the money in the Indian bank account, bankers are coming back to say that, look, under the new law, you're required to do certain compliances, which were not done when the old investment was made. You regularize it, and only then I will allow to credit the money. So as you see that when I did the transaction, it was completely fine, but now when I'm actually liquidating it, now I am faced with that burden and penal consequences because there's a change. And you will find it at often many places. But despite everything, I think RBI has to be commended that they have done a very superb job in protecting the Indian interests, because the way we could see a flight of capital, or say it could lead to increase in prices of property, etc. If the foreign money was allowed to come to India without any tap or regulation, the things could have been very different. So RBI is more like a gatekeeper to protect us, and we should acknowledge that, despite all whatever the limitations be. So first, before we go who is covered, let's look at very quickly who is not covered. So, a financial institution under GIFT City, IFSC, will, loosely call it a GIFT City, yeah, because now it's a very common known term. So any investment by a GIFT City, a financial institution overseas, is not covered within this, because GIFT City is treated to be a foreign territory when it comes to FEMA, unlike income tax, where it's still a part of India territory. Certain investments, and these type of investment are such investments like RFC account, Section 6(4), foreign currency resource for someone who is coming to temporary in India. These all type of investment are such where you have some foreign interest, foreign money. While you were a non-resident, you are coming to India, and now you are using your foreign money which was earned while you were outside India to do certain activities. And they have clarified that, look, what you earned while you did when you were a non-resident, using that money will not cover under the new regulation, right? So there is some sort of a relaxation that, look, although I've come back to India, any investment I'm doing from India will be covered. But if I have certain money which is outside India held under, you know, specific regulations, I can continue to invest the way I want, subject to overall framework. So what do you really mean by overseas investment? So overseas investment means an investment which is made in a foreign entity. What is a foreign entity? We'll look later on. Engage in a bona fide business activity. Now here it is very important that any investment that doing from India has to be in a bona fide business activity, and if not, then this investment is not permissible under the RBI framework. And what do you really mean by a bona fide activity? They have kept it very open and wide-ended to say that it means any activity which is permissible under the law of India as well as the host country jurisdiction. So any example that we could think of, that what could be permitted, not permitted in India, but permitted overseas, and whether we can make an investment in such an businesses. Any idea, any example that you can think of that what could be not okay in India but could be okay if you are doing outside India? Betting, casino, betting, right? So of course there is still a debate whether it's a luck or a skill, but yes, betting could be one of the example. Some examples RBI has specifically clarified that you cannot do. One could be marijuana business, could be legal outside, but India is prohibited. So if you are investing into a company which is into that, it is not a bona fide business activity and you cannot invest. And this applies to both investment, overseas direct investment as well as portfolio investment, which is a OPI, right? And we see what the difference is on this. There are certain activities which they have blanketly said, no, you cannot do. And these are specific restrictions which are put up, wherein gambling is one of them. Dealing in financial products linked to rupee, like if there are any investment to company which is linked to stock indices in India, or involved Indian currency exchange rate, those are not permitted. Gambling, you have already identified that. Real estate activity. Now this is important and we would spend some time on real estate activity. So our typical understanding of real estate activity is a little different than what the law envisages. See, law and in FEMA, real estate has been defined under multiple regulations with a different purpose in FDI, in ECB, in overseas investment. But what they really intend to cover by not permitting a real estate activity is that you should not have a foreign outflow or inflow of capital for a speculation, that you buy and sell the property without meaningful construction or which adds to the economic value to the country. So what they have defined a real estate activity is that it means buying and selling of real estate or trading in TDR. So if you are only engaged into that activity, then it's a real estate activity. You cannot invest into such a company. But, and they have clarified, it does not include development of township, construction for the purpose of selling or leasing, right? Now, let's look at some examples. So if suppose you are investing into a company which is engaged in buying and selling of property, blanket, cannot invest. If you are investing into a company which is buying and leasing a property, whether that is okay? No. Anyone who thinks differently, yes, should be okay. Mixed view, few people feel yes. So here, if you look at the definition, and I said, very legal interpretation, we may want to keep it a little aside and look at what really the intention of the law is and what really RBI looks at it. So buying and leasing per se should not be permitted. If you are constructing and leasing, possible. Construction for the purpose of sale, very much possible. So, when we loosely say real estate, we really have to look at it, what we are doing it. And now there are various models which have emerged, right? You could possibly buy a land for leasing it to a hotel resort, and there are multiple complexities which come by. So every fact you need to really dig through from the definition of real estate and see whether it is permitted, not permitted. Then, of course, investment into certain jurisdictions will require prior central government approval, and if it is exceeding a particular threshold, it requires a prior RBI approval. So while we spoke about overseas investment, let's visualize what it really covers, right? So there are two aspects to it. One is a financial commitment, and one is a portfolio investment. Portfolio investment you need to understand more like something where you are investing only from the, not from the perspective of a strategic investment, more in terms of listed and those kind of instruments. Financial commitment is where we really are focusing on, because we'll have a lot of Indian entities who may want to venture outside India for their business purposes, and they would want an advice about how I can really do it, right? So overseas investment is a larger framework, covers a financial commitment, which has again two categories: ODI, which I will loosely call it to be equity; debt other than OPI and non-fund based facility, which I will loosely call debt in the presentation. So financial commitment is nothing but equity plus debt plus your portfolio investment, and that gives you an overall framework of a overseas investment. So what do you really mean by overseas direct investment? So overseas direct investment is basically your equity, as I was loosely referring it to. So what will include in equity? Your normal equity share capital, your subscription to memorandum of associations, your investment into a listed company more than 10%, 10 or more than 10%, your investment into a listed company less than 10% but with a control. So all those items which indicate you have a strategic interest are sort of an equity and ODI. Now when you look at it, equity capital questions could come whether a OCPS or a CCPS or a OCD or a CCD will cover, not cover, right? So we also look those ahead. So broadly, if you look at ODI, is like your equity involvement in the company with control when it comes to a listed entity. Portfolio, on the other hand, is anything which is not a overseas direct investment, but they have expressly excluded certain items like unlisted debt instruments, security by IFSC, derivatives, commodities, and these are the prescribed things which, although may look like it's a portfolio investment, RBI does not cover it to a portfolio investment, which means there's a prohibition for investment. Question is like example, let's look example of the listed company, right? You have more than 10% today, so you have a control, and it's an overseas direct investment, and you are selling say 5% stake. Now next year, you only have 5% in the listed entity. Now whether there is an overseas direct investment, so if a new person is investing only 5% without control, no. But because you were earlier a overseas direct investment, regarded as an overseas direct investment, even if you are diluting your stake, it continues to retain its nature of a overseas direct investment. In the earlier slide, we read investment by acquisition of a unlisted equity capital of a foreign entity. Now, what do you really mean by foreign entity, right? So, foreign entity means an entity which is formed, registered, or incorporated outside India or in GIFT City, IFSC. Very important, having a limited liability. See, whenever you are taking an exposure outside India, RBI is always mindful of the fact that you should not create a situation where India is exposed in terms of any debt obligation or in terms of any unforeseen unlimited liability situation. So your foreign entity has to be a limited liability. However, there could be certain sectors, there could be certain investments where having a limited liability may not be workable. So there are exceptions and relaxations given. So if you have a strategic sectors like energy, natural resources, and even startup, startup is also included as a part of a strategic sector where limited liability restrictions do not apply. Of course, there are certain other conditions that need to be in mind. Your question, and there is some ambiguity here, like what do you really mean by a startup, right? In India, if you were to call someone a startup, you will say, give me your DPIIT certificate to show that you are a startup. So there are some law legislation to govern what a startup is. Not necessarily a foreign entity has such, regulations governing a startup. So commercially, loosely, we may call it a startup, whether it is a startup as per the host country law, etc., is still a open question. So we know that, okay, these are the foreign entity in which we can invest as an overseas direct investment. This example we took for the listed, but when it comes to an unlisted, right? Even a one share investment into an unlisted company is considered to be a overseas direct investment. And this is very important because the old law didn't have this expressly, which is now covered under the new law. So now anytime, even a $1 investment in an overseas entity, which is unlisted, will be regarded as an overseas direct investment. For listed, we already look at those criteria. We spoke about control, and control will come at a lot of other places as well. What do you really mean by a control? Right to appoint majority of directors. Yes, because I'm able to control that entity, decision making of this entity, etc. Right to control management or policy decisions which are exercisable by a person in concert and otherwise. Yes, control. And these definitions of control are very much similar in your Companies Act, in your SEBI regulations and all. But there's one flavor which RBI added, is the threshold of 10%. So if you have a 10% or more, whether or not you have a right to appoint directors, etc., it will be considered that you have a control. And here it is important to keep this in mind. This 10% criteria is very important. And we will come at multiple places where this control will come by, and our normal understanding of the terms will be questioned, will be challenged, will be different than what we thought. Right? So, wherever we are discussing a financial commitment, whenever we are discussing a reporting requirements, the permissibility to do a transaction, this definition of control will come handy. So now let's look specifically as an Indian entity, what it can do as an overseas direct investment. So what do you really mean by Indian entity? Your company, your body corporate, your limited liability partnership, your partnership firm which is registered as per Partnership Act. So unregistered partnership firm is not covered within the definition of Indian entity. And I have kept what you can do as an individual as a separate segment so that we first focus on what is to be done by an entity. So we earlier looked at equity and debt. Remember financial commitment which has equity and a debt, right? So what do you mean by an equity? What do you mean by a debt? So your equity is basically your equity shares, perpetual capital, irredeemable instruments, compulsorily and mandatorily convertible instruments like a CCPS, a CCD. These all are nothing but your equity capital. Whereas your OCD, your non-convertible debt, non-convertible preferences, your loan, your guarantees, everything is a debt. And there are different regulations which govern equity. There are different definitions which govern debt. There are conditions when you can give a debt. So everywhere the bottom line comes by what you are able to do, how much you are able to do from India. Because RBI would always keep a tab over how much is the money going out of India and is it under control or not. And hence they have laid down a parameter that if you want to do a financial commitment which includes both equity and debt, you can do up to 400% of the net worth. If you want to do a portfolio investment, which is available because we are discussing an entity, not covering an individual at the moment, for an entity only a listed entity can do a portfolio investment up to 50% of the net worth, and unlisted entities only in IFSC. So if an unlisted entity wants to buy shares of Microsoft, not possible. And if you look at the intention of RBI, like they are giving a higher leverage when they're really looking at you doing investment into entities where there is a business, where there is strategic investment, strategic role, versus where it's more like a portfolio. So it's a 400% net worth when you want to do an overseas direct investment versus a 50% if it's a portfolio even for and that too only for a listed entity. Net worth has to be as per audited balance sheet. Net worth is defined for companies under Section 257, and for limited liability partnership or a partnership would include your capital, your undistributed profit, reduced by the losses and the expenditure. Yeah? Hmm. No, no. So OPI for a IFSC is into like instrument like an AIF, you know, CAT 2, CAT 3 AIF or FIF that you're doing. It is an OPI. We have a specific slide on IFSC. So if I'm investing into a company which is like a fund management entity, example in a gift city, then that will be under the ODI regulation. So we have a specific slide we'll cover at that point of time. So now question, yeah. No, not necessarily. So if we go back, it is investment other than ODI. So per se includes lot of instruments, whether debt. So unlisted debt is specifically excluded. Whether listed debt, yes, it is a portfolio. Yes, and here often if you are dealing with a lot of startups, you will and while we are at this slide, I also want to add, well, when you are dealing with a lot of startups, you would hear I want to invest into safe product in US, right, which is very popular in US, which is like a simple agreement for future equity. So it is basically like I will get equity at some point of time, probably, on some terms if some event happens. So it's a very fluid type of instrument, which is neither sort of like a CCPS or a CCD, nor a equity, possibly a debt, not a debt, and there's a lot of ambiguity on this. And the present view is that safe investment, you will not be able to do it, unless that is in the nature of a CCPS or a CCD or equity. Question is audited balance sheet. So what if suppose I am doing an investment today, say this July 2025, I have a balance sheet of March 24, March 25 balance sheet is not yet completed, right? Can I do? Yes, up to 18 months you have that leeway. So because September is generally the time while your audit gets completed. So before September you can still rely on a March 24 balance sheet to do the investment. What if suppose March 25 also audit has been done, then you'll have to take March 25. Now assuming March 25 you don't have a sufficient net worth, and you did a fresh round of equity infusion say in June, by virtue of which now you are able to meet the 400% net worth criteria. Can you do the investment? Yes, you'll have to get the audit done for June, have a revised net worth, and basis which you can very well do the investment. So you're not linked to a particular date. Any point of time, if you have done some equity infusion whereby your net worth has increased, you could always have the audit done as on that date, and you could invest. Normal, instant, statutory audit. So it should be in a Companies Act, LLP Act, as the case may be. There are certain points, like what should happen that if you are a NPA or if one of is a willful defaulter, then earlier there was an issue in doing the overseas investment, wherein the regulatory authorities were not giving a permission to do. They used to just sit on the application, and you were not able to do the overseas investment. Now they have come up a point that okay, you apply to those institutions for a no objection for doing overseas investment, and if they do not respond within 60 days, it will be presumed that there is no objection. So it gives a time-bound commitment for them to accept or reject. Otherwise, you are just in that limbo and you are not able to do the investment because some other agency or authorities are not responding, right? So this is a welcome change where they have actually brought in a timeline where you have to say a yes or a no. So how can you make an overseas investment? You are subscribing to memorandum, you can acquire the shares, equity capital, you can do it through a bidding tender process, you can capitalize certain processes if those are under compliant, if you have some receivables which are compliant under the law, realizable, there's no approval required to realize that money, you can convert them into equity. There could be a swap of securities if there's some merger, etc. happening, and you are, getting a foreign investment against a overseas investment or against an Indian investment. Those swap, ODI, FDI swap is permissible on account of merger, etc. So there are various modes which practically covers by and large everything that an Indian entity would otherwise do in terms of acquiring a overseas direct investment. Now we saw a lot of sectors, like we saw real estate, we saw gambling not allowed, etc. There's one more sector which has a very special reference in the overseas investment framework, which is a financial service activity. And what you really mean by a financial service activity is any activity which, if you would have done in India, would have been regulated or would require a registration with a financial service regulator in India. That is a financial service activity. And there are certain special conditions which become applicable when a entity wants to do a overseas investment into a financial service sector activity. Of course, banks, NBFC have their own guidelines, own legislations, own regulations which govern what can be done, what can be not done as per their laws. But for an entity, what the ODI framework says is that if you are an entity which is engaged in a financial service activity and you want to invest into another entity which is into a financial service activity, then the Indian entity has to compulsorily have a profit for last 3 years. Indian entity should be registered, regulated by a financial service regulator in India. It should have obtained approval as may be required from both the Indian regulator as well as the host country regulator where that activity is being proposed to be undertaken. So when it comes to a financial service activity, there is a lot of legislation, regulation that comes into picture. What if a normal operating entity in India, which is not governed by any financial service regulator in India, wants to invest into an activity overseas which is into a financial service sector? Permissible without other than banking and insurance. Condition, apart from the net worth condition, etc., an additional condition that you should be profit making the last 3 years. Insurance again has some special condition that you could do only if it supplements your activity in overseas. Like example, if you are doing some motor vehicle manufacturing outside India, then a corollary could be, a vehicle insurance entity you are investing, or if you have hospitals, etc. outside India and you are investing into a medical insurance company. Only in those limited situations where it supplements your business activity that you're doing, you could do in an insurance sector. Practically, there have been some reservations in actually processing such type of transactions. While permitted as per the law, as per the regulation, practically we have seen some difficulties when actually these transactions have to be undertaken. Now, here we would also want to touch upon the concept of round tripping, right? Round tripping, as it was never defined earlier also, but there was an express prohibition by RBI that any round tripping structure will not be permitted. Though it was not very codified in any of the regulations, etc., it was some part of some FAQ which RBI had issued, and by virtue of which round tripping was blanketly prohibited. Now they have clarified that what could be still a permissible structure under round tripping, and round tripping is more like a commercial word that has been devised. Nowhere definition is regarded to be a round tripping, but commercially people refer to a round tripping because of the structure. What they say is that an Indian entity cannot make a financial commitment into a foreign entity that has invested into India if it results in more than 2 layers of subsidiaries directly or indirectly. Which means, let's take an example, an Indian entity investing into Singapore entity investing back into India, very plain vanilla structure. Earlier it was not permitted. Now if you look at it, are there more than 2 layers? If not, then that should be permissible. There are some exceptions to banking, insurance, government companies, but I think we don't look into it. So this round tripping is now expressly being provided. Now we will little complicate the example about what a layer is and look at it how do you really calculate a layer, right? Before that, what it says is you should have 2 layers of subsidiaries or a step down subsidiary. Our traditional understanding of subsidiaries that I should have at least 50% or more than 50% stake for qualifying it to be a subsidiary, or you should have some control as per India's, etc. RBI says subsidiary or a step down subsidiary means an entity in which you have a control. And we go back to the definition of a control, which had prescribed a percentage, 10%. So even if you have 10% or more in a foreign entity, it will be considered to be your subsidiary. Though in normal parlance, we don't regard it to be a subsidiary. One of the relevance how control comes into place, right? So let's look at what layer are okay, right? So India to Singapore to India, okay? Yes? India to Singapore, Singapore to Dubai, Dubai to India. Okay? India to Singapore, Singapore to UK, UK to Dubai, Dubai to India. So what is the layer that you count, right? So India to foreign entity to another foreign entity, and foreign entity to India entity should be permissible, but beyond that layer, there's an issue. Right? So this was what we understood about equity capital, right? So just to summarize what we learned until now, Indian entity, it includes your company, LLP, registered partnership firm, body corporate, can invest up to 400% of your net worth by way of an equity capital, which includes your equity, CCD, CCPS, those are typical instruments, in a foreign entity, which has to be limited liability, unless it is in a strategic sector, for a bona fide business activity, which means a permissible activity in India and outside India. And now we look at what is a investment through a debt or a non-fund base. So see, when you're typically businesses are operating, you will not fund the entire capital by way of equity. There will always be a capital debt mixture. Often there will be a need to give a guarantee, right? So, or take a loan outside India, sometimes could be cheaper because you are anyways dealing in forex country. You will always have a natural hedge if you are taking a loan from overseas entity, overseas bank, rather than India because of the currency fluctuations. But the overseas entity may not be self-sufficient, so you may require to give a guarantee, right? So these could be the practical instances which would come by. And let's look at what is permissible as a debt, what is permissible as a non-fund based facility. Can an Indian entity give debt, blanketly without any regulation, any permission, any criteria? No. Indian entity can give a debt which is loan or a guarantee only if it fulfills the following conditions. 1, Indian entity is eligible to make an ODI. So all that we learned until ODI, I should be able to satisfy everything, only then I'll be able to do a investment by way of a debt or a guarantee. I should have actually made a ODI. So not only I should be eligible, I should have actually made a overseas direct investment. And I should have a control in the foreign entity. So all the 3 conditions, eligibility, actual ODI, and a control, all 3 are important and relevant. Only then I'll be able to give a debt or a guarantee. Again, control, the definition which comes by, right? So what if, suppose I have a 5% stake into a company. It is a ODI, I am eligible to make an ODI, condition 1, yes. I have made an ODI, condition 2, yes. Because even a $1 investment into unlisted is always an ODI. Whether I'll be able to give a debt? No. Because I don't have a control. So this becomes very important that when I'm able to give a debt, when I'm able to give a guarantee. So now let's look at debt or a loan, right? So permissible, if I am doing all these conditions, I should have a loan agreement and the rate of interest should be charged on an arm's length basis. Some tax concept coming by, some transfer pricing concepts coming by. Even FEMA requires that you will be able to give a loan only if the interest rate is on an arm's length basis. Hitherto what used to happen is, we have seen a lot of loan arrangements where probably the foreign entity is really not making money, etc. And the loan agreements have been structured as a 0.1% interest and so on and so forth. And probably the contention under transfer pricing is a shareholder function, etc. and all, right? Leaving tax aside, under FEMA it is not permissible. So because they will expect you to give a declaration stating that the interest is at arm's length, and hence you will have to actually mandatorily have that in place in your agreement. We read that there could be multiple layers, etc., right? We spoke round tripping when it was India to overseas and coming back to India. What if I have a multi-layer structure outside India? There's no round tripping because it is not coming back to India. Example, India to Singapore, say Singapore to Dubai, Dubai to UK. I can do it if the host country laws permit, because it is not coming back to India, so the layering would not be applicable to me, right? Now what if suppose my UAE entity requires a loan? Will I be able to give a loan? So let's look at the condition. Why? Have I made an ODI? Am I eligible to make an ODI? Yes, because I already done through the layer structure. Have I actually made an ODI? No, because I have made an ODI in the UAE, in the Singapore entity, not directly into the UAE entity, right? So while I can give my loan to a Singapore entity, who in turn can then give the loan to UAE entity, I can commercially route the transaction accordingly, but the direct possibility of giving a loan to the Dubai entity, not possible. We spoke about, earlier the loans were given at 0.1% interest, etc. What happens to those arrangements? Those were already done, concluded under the old regime where bankers have accepted, money has gone by, instruments are existing, loans are existing. The requirement now is that even for those past instruments, bankers are insisting that no, that should be at arm's length. So you should change your terms, right? Commercially, this could become very difficult, that I have already given a loan on some XYZ terms. How do I change it? But again, some change in regulations are there. Now let's look at what you can do by way of a guarantee, right? So often it happens that I may not want to give a loan because maybe interest rates are cheaper outside. I want to hedge against the forex fluctuations, but I give a guarantee because independently that entity may not be able to avail a banking facility, but with my strength in India, they can very well do it. So let's look at what all guarantees are permissible. Corporate or a performance guarantee by the Indian entity, very much permissible. Corporate or a performance guarantee by a group company of such Indian entity in India. So although I have not made a direct investment overseas by that group entity into the foreign entity, and hence I could not have given the loan, regulations specifically permit a guarantee. So if suppose Indian entity which has invested in Singapore entity has a holding company wherein the holding company holds at least 51% in the Indian entity, and Indian entity has satisfied all the other conditions, then this holding company in India could extend a guarantee to the Singapore entity even though it has not made a direct investment into the Singapore entity. So a loan, no. Guarantee, yes. Similarly, if this Indian entity has some subsidiary, even that's in India, even that subsidiary could give a guarantee to a Singapore entity. Or if it is any entity within the promoter group, even those can give a guarantee to the Singapore entity. Even a resident individual promoter of an Indian entity can also give a guarantee. Now generally a resident individual cannot give a loan, cannot give a guarantee, but here there is a specific exception given. If that individual is a promoter of the Indian entity, it will be permitted to give a guarantee. Can it give a loan? No. And also bank guarantee, etc., where you go to an Indian bank, you give up them a guarantee, Indian bank gives you an SBLC in favor of the foreign entity, against the SBLC foreign entity can avail a loan, even that is permissible. So the distinguishing factor, loan to a step down not possible, guarantee to a step down possible. And what could be a different type of guarantee? Performance guarantee, and they are categorized into two baskets, performance guarantee and other guarantees. Performance guarantee would depend upon the validity of your contract, and if that is invoked, you don't need an approval. You can very well make the payment under the new regime. Other guarantees, like your corporate guarantees, you can very well give them, but they cannot be open-ended. So they have to be for a fixed period, and you can renew it, after the completion of the period. But it cannot be like I'm giving an open-ended guarantee, like I'm guaranteeing the loan for the Indian subsidiary. That is not permissible. So in year 1, I gave the guarantee, right? Because it has to be open-ended, I gave for 1 year. At the end of the first year, I have to renew that guarantee. I'm rolling over the guarantee. Whether it will be again counted as a financial commitment and consume my 400% net worth? So no. Unless the second guarantee, the rollover guarantee, is for an amount which is higher than the original amount, then yes, that will trigger. But so long I am just continuing the same amount, it should not trigger an additional financial commitment. It will be subsumed within the original financial commitment. And because it is a non-fund based, it is treated and reported as a non-fund based commitment. Whenever it is invoked, it is treated like a debt and has to be reported accordingly. So how much percent? See, there is no cash outflow. I have just guaranteed, right? So what do you really count towards the utilization of the commitment? So for a performance guarantee, 50% of the net worth is counted. 50% amount is counted towards the financial commitment. Whereas for a corporate guarantee, 100% of the amount that you have guaranteed will be counted towards the financial commitment limit available to the Indian entity. When it comes to a guarantee by a group company, it will be counted towards the limit of that group company. So example, it will be counted towards the net worth of the holding company in our example and not the Indian entity, right? So if the Indian entity has a net worth of say 100 crores, it can give a financial commitment of 400 crores. If the holding company has a net worth of say 200 crores, it can also give up 800 crores. But any inter se, loan or a guarantee or an exposure between the holdco and the Indian subsidiary will have to be reduced. Otherwise, it will duplicate the net worth calculation. We saw that resident individuals are otherwise not permitted, but only a special scenario where they are able to give a guarantee. And again, a special scenario that it is not counted towards the utilization of the individual's net worth. So, although the individual is giving the guarantee in his personal capacity, it will be consumed towards the net worth of the Indian entity which has actually made the overseas direct investment, right? So, there is a departure about what is being consumed. Similarly, if it is by a promoter, it will be counted towards a promoter group. What if two people are jointly and severally giving the guarantee? Will you do a split 50-50 or 60-40 or anything? No. Each entity will consume its entire amount that it has guaranteed as a part of its commitment for utilization of the net worth. So if two entities, say holding and a subsidiary, have jointly given a guarantee, it will be counted towards the net worth utilization for both these entities respectively. Right? So now we have understood your equity capital, we have understood your loan and a guarantee. Again, to summarize loan and guarantee, I can give a loan if I am eligible to do an ODI, have done an ODI, have a control. Control, we go back to the definition. One of the parameters also at 10%. So then, if I satisfy these conditions, I can give a loan. I can give it to the entity in which I have done the investment. I cannot give it to a step down. I have to charge interest at arm's length basis. Guarantee, I can give even if, I don't satisfy the earlier conditions, right? So guarantee can be performance or a corporate guarantee, cannot be open-ended. Guarantee can be given to even a step-down subsidiary, not necessarily a subsidiary. Definition of subsidiary goes back to the definition of control, where even a 10% qualifies to be a subsidiary. Utilization is done towards the net worth consumption for the amount of guarantee which is being given, if jointly for both, if given by resident individual promoter towards the entity of towards the net worth of the Indian entity. So this pretty much summarizes your investment overseas by way of an equity, by way of a debt, which includes a loan and guarantee. Are we good until now? Are we okay with the pace? Do we want to slow down? We are fine. Good. Okay. Investment kar liya, abhi kya? Now I want to disinvest. Again, RBI comes into picture because they would always want to protect the Indian interests. So again, they have some regulations, some requirements when it comes to a disinvestment. So what they say is generally, you are permissible to disinvest, and disinvestment would be, selling the shares, could be liquidation, and could be dissolution, could be those, all everything is covered by it's basically a transfer. You can do it subject to compliance with FEMA. The conditions could be your pricing guidelines have to be there, documentation, etc. have to be complied with, and yes, you can very well disinvest, but some specific conditions that need to be understood. I cannot hold or transfer an investment if my initial investment was not permitted. So if I had done an investment which was on contravention of FEMA, can I transfer? I cannot transfer. Can I continue to hold? I cannot hold. And this becomes very relevant because, if you are acquiring some stake, while we are on disinvestment, it will also mean that someone else is disinvesting and we are investing. We should ensure that his holding, if he were a resident Indian, is compliant. Otherwise, even the transfer by us or acquisition by us could have an issue in continuation of that investment. So what are the conditions? They say this investment, partial or full, can be possible only if the Indian investor has invested for at least stayed invested for 1 year after making this ODI, right? Why? Because they don't want any short-term trading. Because they have categorized it like a ODI, they are expecting it to be a longer duration. So they have kept a condition that you should have invested for at least 1 year. Only then you will be able to disinvest. What if you are completely exiting from the structure, right? Are there anything that needs to be further taken care of? Yes. You should not have any outstanding dues on that foreign entity other than on account of equity or a debt, right? So other than a liquidation, if I am disinvesting completely, if I am having some investment, then RBI is still okay to have some receivables, etc. But if I am completely exiting the structure, by virtue of which I may not have any right in the structure into future, and which is not a case of liquidation, then I should not have any outstanding due on account of our equity or a debt. Which means if I have some interest receivable, there should not be an interest receivable, there should not be outstanding debt, there should not be dividend receivable, etc. What if I have some export receivable? I'm divesting from the structure completely. I don't have any debt, I don't have any dividend, interest, etc. But I have given a service to that entity, I have a receivable from that entity. Whether that is permitted? Yes, because the restriction is only outstanding vis-a-vis a equity or a debt, not in vis-a-vis a business transaction. Similarly, whatever money that you are getting by virtue of this investment has to be realized and repatriated back to India within 90 days. Because the fundamental rule is foreign exchange belongs to the country, not you. Although you have earned it, it belongs to the country, and you have obligated to bring back that foreign exchange to India. So far, we have looked at from an entity perspective, what can be done, what cannot be done, which are the modes, etc. Let's move on to a overseas investment that is available for an resident individual. So everyone will be familiar. Any foreign thing that you do, there is a LRS which comes by. Even income tax has now TCS on LRS, etc. Right? So what do you really mean by LRS? It's a window given by an RBI that look, I give a certain amount to you, which you can utilize for doing the activities which I have prescribed, capital or current, under that regime, and that limit is $250,000 or equivalent. And this is an annual limit per financial year, April to March, renews every year. So like we had that 400% criteria for an Indian entity, for an individual, we have a monetary limit of $250,000. And this subsumes your overall limit, which means if you are doing an overseas investment by way of an equity, the limit gets consumed. If you are buying, say, a listed equity instrument outside India, limit gets consumed. If you are buying an immovable property outside India, limit gets consumed. So it's an overarching limit within which even overseas investment forms one part of the bucket. How you can acquire? Pretty much quite a few things: inheritance, gift, ESOP, sweat equity, swap of securities, capitalization, right issue, bonus issue. Pretty much you can acquire in most of the modes. Like we saw there were restrictions for an Indian entity, there are restrictions for individual as well. So apart, yeah. So other modes, like, if suppose you are getting an ESOP of a foreign entity, right? So ESOP is also a recognized mode by which you could get a equity instrument outside India. It comes, the ESOP, there is a specific limit, I'll come to that. But this continues to apply. So the limit of 250,000 is overarching limit. There are some exceptions, like ESOP is an exception, which we will see when we are discussing that. That way they have given some exceptions. gift per se, you are receiving a gift foreign security. Again, gift is covered, wherein if you are getting from a resident relative, there is no limit, etc. So again, that is a specific thing. Yeah. So yeah. Sorry. So the question is, what if I get an ESOP of an unlisted company, right? What will be a ODI? What will be a OPI? What do people feel? ODI? Okay. We park that question, we park that answer, and we will go through it a little later on. Yeah? So, we said even $1 investment into an unlisted company. Correct. So the concept of strategic and portfolio was under the old regulation. This concept is no longer there in the new regulation, right? And what they have defined is what is an ODI. They say any investment into an unlisted entity is an ODI, period, right? So they are treating it to be an ODI. But for this ESOP, we have a slide on it. We'll discuss at that point of time. But presently what we have understood is, yes, if it's an unlisted company, because it's an investment unlisted company, we say it is a ODI, okay? So what are the restrictions for a resident individual? A resident individual cannot make an overseas investment into a foreign entity which has a subsidiary or a step-down subsidiary where the person has control. Again, the definition of control comes into picture on two count. One, what is a subsidiary, what is a step-down subsidiary? Second, what a resident individual has a control. So example. We took an example of an Indian entity investing into Singapore, investing into Dubai, right? The same structure, instead of Indian entity, if I replace it by a resident individual. Can a resident individual invest into a company in Singapore which has a subsidiary in Dubai? No. Because I have a control in the UAE entity. What if I don't have a control? If suppose I don't have a control in the UAE entity, right? Then can I, and if suppose there's a listed entity, so you are investing into say Apple. Apple could have multiple subsidiaries outside India. Do you have a control on Apple? No. Can I invest into Apple? Yes. Right? So here it's a very important and distinct fact that there's a very important restriction when it comes by. Because see, often what happens is client would come by, okay, I have a private limited company, can I do an investment from an individual capacity? You know, so that probably it is tax efficient, I get the money directly, etc. There could be multiple factors, right? Yes, but two restrictions to be kept in mind. One, step down. Second, we spoke about loan, right? So if you require funding, how will you fund that structure? Through a debt. So those are important considerations will come into picture when deciding whether you want to invest through an individual or through a company. Similarly, we said financial services has some special treatment. In the Indian entity, there were a condition of a profit track record. There was a condition for a prior approval if it's a regulated entity. For an individual, it is blanket no. You cannot invest into a foreign entity, engage in a financial services. Are there exceptions? What if I am working, say for example, HSBC Bank outside India, I am getting an ESOP. So do I say I don't get an ESOP? Just because an individual cannot make an investment in the financial service sector entity, can I not do it? Because HSBC is a listed entity, so that may not be a very right example to do it if say it's an unlisted entity, alright? Then whether I forego my stake for a ESOP, answer is no. There is an exception. There are certain modes, and hence there was a slide on the modes, by virtue of which I can acquire stake even in a financial service activity. Like an ESOP is one of the mode, sweat equity is a mode, minimum qualification shares is a mode. That in those, if I'm getting by those mode, I can acquire even a stake in a financial service activity. Second is on the gift city. Gift city has been given a lot of preferential treatment, quite a few places, in income tax, in other regulatory laws, even in FEMA, in overseas investment. So I can invest into a financial service sector entity in a gift city. 2 points to note here. Suppose that financial service activity has a step down. can I invest? A Russian individual, India to Singapore to UAE, no. India to Gift City and Gift City has a step down. Can I invest? Yes. If I don't have a control, definitely I can invest. If I have a control, I can invest if the step down is within Gift City. So there is a relaxation for the sector as well as for the step down criteria. I cannot give a loan, cannot give a guarantee, except what we covered ahead. Startups, we remember it was a part of a strategic sector. I can invest, but only out of my own funds. And a resident individual, and this is a very important point to note, a resident individual cannot gift overseas investment to a person resident outside India. So if an individual is wanting to give gift of a overseas investment to a person resident outside India, it cannot give under the framework. We had some questions on gift, etc. Yeah. Yeah, is this slide? Yeah. Yeah. ODI. Right. So as I said, that's why the reason I corrected that HSBC is not a correct example. Because what is not permitted is a ODI. That will be a portfolio. Right. So question is, can there be ever a limit on me getting things by way of an inheritance? Logically, no. Right. So if there is something coming by inheritance, not by virtue of my will or anything, will in the sense my personal wish, it is coming out of a legacy, a bequest, which is coming to me. So there is no limit whatsoever when I am getting anything by way of an inheritance. Whether it is from a person resident in India, whether it is a person non-resident in India. Question is on the gift, right? Can a resident Indian gift to another resident Indian, right? And I've put a very loose question, right? So I'll give an example. Here, a resident individual wants to gift a foreign currency to another resident individual. Whether it is okay? No. LRS has a restriction. A resident cannot gift in foreign currency to another resident. But overseas investment has given a carve out. A resident can gift overseas investment to another resident, but who is a relative. Relative as per Companies Act. So a resident can gift overseas investment to a resident relative who has, of course, it should be a compliant investment because you cannot hold transfer, investment which is not compliant. But this is possible, but only a relative, not the 56 to 10 definition of Companies Act, which is very narrow, right? So this is something that you need to keep in mind. Similarly, me getting a gift from a non-resident. So if I'm getting something free of cost, why would someone mind, right? When I have to give, there is some, departure which is coming from mine. But when I'm getting something which is a limited liability, of course, so I don't have to pay if there is some, problem with that entity, etc. So then they have said, yes, I can get a gift from a non-resident, not caveating with a relative or otherwise, subject to compliance with FCRA law. So FCRA, whatever reporting, etc. has to be done, you have to do it. But otherwise, under FEMA framework, possible to receive the gift from a non-resident. Right? We had questions on ESOPs, right? So acquisition of ESOP is permitted without limit. By whom? An individual who is an employee or a director of the Indian office, Indian subsidiary, Indian branch, or Indian entity in which there is a direct or indirect foreign equity holding, right? So can I get an ESOP of any entity fashion? Yeah. So that is a FDI question. We are on overseas investment, but there is a issue because you require an RBI approval, and that to maximum to $50,000. So there is a issue on that. So it's a part of FDI. So it's not a coverage, but to answer you, you cannot gift it without RBI approval. Yeah. So on ESOP, yes, I can acquire without any limit. What are the conditions, right? the scheme should be offered globally on a uniform basis. So it should not be exclusivity to you, because you could see we are very engineered minds. What cannot be done directly cannot be done indirectly. And that is the fundamental principle of FEMA. That you see, income tax, you could structure a transaction to achieve your commercial objective, right? But FEMA says what you cannot do directly, you cannot do indirectly. Like even like example, a bona fide business activity, right? Can I, if suppose example, I want to do a marijuana business, right? Step down is allowed for an Indian entity. I set up an Indian entity. Indian entity in turn sets up the, say, Dubai entity which is engaged in the marijuana business. Have I achieved the commercial objective? Yes. Whether permissible? No. Because bona fide business activity has to be adjured not only by my subsidiary but also by my step down subsidiary, right? So the rule under FEMA is very clear. What you could do directly, that only you can do indirectly. So ESOP could be a way people could structure, like you have a lot of relaxation in ESOP, no limits for an individual, financial service sector gets open up, etc. So there are some checks and balances which are in place. That ESOP has to be on a uniform basis, like, generally your scheme is floated that people of some X position are entitled, uniformly. There are some gradings, some years of experience. So there has to be some uniform criteria, and by virtue of which, if a resident individual is getting, yes, it is okay. There was a question whether it is a ODI or what. They have again expressly permitted that if you are holding less than 10% without control, then it will be treated as an OPI. Our earlier was even a $1 is always an ODI. There's a departure for an ESOP. That if I'm holding less than 10%, then, and no control, then it is an OPI. And why this ODI, OPI would make a difference? Why it would make a difference for an individual? Say I'm within a $250,000 limit. Whether it's a ODI, OPI, how does it matter to me? It matters because there are a lot of reporting obligations which get triggered. And as an employee, if I'm getting an ESOP, I may not want to get into the hassles of reporting, etc. I may not have the data to do the reporting also. So they have consciously given a carve out, right? There are other modes of investment, but these are not very frequently used, so I'm not getting covered into the AIF, trust, mutual funds, etc. But yeah, gift city is something that will look, as we had said, that we have one slide on it. So a resident individual can invest, or an individual entity board can invest into IFSC as per OI regulations. Earlier we saw that if an entity wants to do in a financial service sector, a financial service sector entity wants to do in a financial service sector entity, you needed an approval. In an NOC case, we saw that NOC case had 60-day criteria, not specifically mentioned for approval from a financial service regulator, but for a gift city, they have given a specific time-bound manner that has to be disposed within 45 days. Indian entity not engaged in financial service sector, wanting to invest into financial service sector, there was a profit criteria for 3 years. But if the same foreign entity is into a gift city, the profit criteria does not apply. A person resident in India can invest into a gift city fund or a vehicle, which is typically your FIF or a AIF, and that will be treated as a OPI. So you saw that Indian entity, can it buy shares of Apple? We said no. Can it invest into a foreign ETF, foreign mutual fund? No. Can it invest into a AIF or a FIF in India? Yes, as an OPI. Right? There were, whether resident individual can do step down, etc. We saw that we are already discussed when we were at that slide. Right? So gift city has some specific framework around this. So we have understood. Yeah, please. Yeah. That by way of ESOP you are saying, or otherwise? ESOPs, anyway, even foreign ESOP is permitted. So gift city is otherwise treated as a foreign entity. So then that should be a permission. I've not seen those structures where partnership rights are being given, because generally what happens is that the structure is prevalent in very few AIF which are in LLP, wherein you have a GPLP concept, etc. where this could be possible as an investment, because gift city gives a lot of relaxation for even a resident individual to invest, like a financial service sector entity. So I think that should be possible. That continues. There is no relaxation there. That continues, except in that ESOP situation. One thing, while I just remembered on a ESOP, we said it is without limit, right? So, but there's a one caveat to that without limit condition, that although it is a without limit, it is reckoned towards the LRS limit. What do you really mean by that, right? Can a resident individual get, say, $500,000 ESOP in a financial year? Can I invest $500,000 in a financial year? Normally, not ESOP rule, normal investment? No. $250,000 limit applies. Can I get an ESOP of $500,000? Yes, because it is without limit. But it is counted towards your LRS limit, which means once I've got an ESOP in that financial year of $500,000, can now I make another investment under the LRS route? No. So that is a keyword that needs to be understood. Yeah. Yeah. Correct. Correct. So then this regulation comes into picture that you can get without limit. It is counted towards the LRS limit, which means your future investment could get hampered, but does not your existing investment. Yeah. So I think that's a very wide question, and a lot of interplay with income tax, etc. will also come by for a gift city. The question is, like you would have read recently, I think it was an article yesterday or so, I don't remember the date. Gift city regulators are also becoming very stringent. So it is not like you could have a paper office in a gift city and you could, do and take those benefits, etc. They are actually visiting the offices in office hours, and I believe there were 9 FMAs which have been given a warning that their offices were shut because they were not operating from the gift city, which is one of the mandatory condition for being established in a gift city. So when it comes by whether you want to invest through a gift city or a foreign entity, it really looks at what business you want to do. Is there a business which warrants to be in a gift city, or we are looking at gift city only from the perspective of some ancillary benefits, which the latter then becomes difficult unless you have some substance in that gift city. Yeah. For this year. Only for this. Only for this financial year. You can do it. So now that we have understood equity, debt by an Indian entity, we have understood investment by a resident individual. Now let's really look at what are the reporting and the compliance aspect to it. Right? First is how you should make the payment. So RBI is, every dollar which goes out of India is monitored, because you have to give a lot of declarations, purpose, etc. Right? There is no free lunch, right? So RBI said that I want to control, I want to know exactly which entity you have invested. If it's a ODI, I want to know what is the purpose if it is an LRS, right? So your remittance has to be through a banking channel, or there could be certain accounts which are permissible under FEMA, like RFC, etc. You could do it from there. There could be a swap of security, because there could be a merger, etc., where there could not be a monetary outflow, but there is a permissible mode by which you could take an investment, ADR, GDR, ECB, etc. Can I invest in cash? So I went outside India for a travel. So I had drawn foreign currency legitimately under my LRS quota, under my passport, taken the money, went, maybe say UK, etc. I went, US, etc. I went. I thought, oh, it is nice. I want to set up an entity. I gave $1 cash. I said, incorporate the entity. Can I do it? It was a legitimate money using my LRS limit. No. Can I swipe my credit card and do it? No. It has to be through a remittance to a banking channel. Right? So there are certain reporting compliance aspects that you need to take care. Another is on the deferred consideration part. Yeah. So that is coming out of LRS. Now you're practically any LRS investment that you do, you are allowed to retain, reinvest within 180-day period. There are two views in the industry in terms of, when I initially sent the money, I had given the purpose code of investment to listed instruments. Right? Now I am realizing it and I'm investing into a real estate property. Right? One view is that law permits me to reinvest, retain within 180 period. If I'm doing it, it should be okay. Second school of thought is that at least the AD banker should be informed that there is a change in the purpose code. I think better to be conservative. No. Borrowing is not permitted. Borrowing is not permitted. No. You have to give a declaration when you are doing LIC's own money. It's not permitted. So, see, there could always be instances when you are actually investing overseas where you may take the stake in a staggered way. You could set up a company, like it's very easy to set up a company in Singapore or Dubai, maybe in a week you could have the company up and running. But the bank account, you would take at least 3 months, 6 months extra to actually have an operational bank account, if at all you are able to get it, and then remit the money. So what happens? You set up the entity, you wanted to send the money, you could not send the money because the bank account was not functional, which takes significant amount of time nowadays with all this AML guidelines, etc. Am I permissible to do it? New regulations have given a very express clarity that deferred consideration is permissible, subject to certain conditions, that it should be for a definite period. You should specify whether it is 3 months, 6 months, 1 year, 2 years, and it has been decided upfront when you are making the investment, backed up by some document. I should have received the shares issued to me upfront, which means I have a right on that shares, although payable towards the consideration. There are certain pricing guidelines which come into picture. My overall payment that I make towards this acquisition, even considering the deferred payment, has to be within the overall pricing guidelines, which we'll see in later. And there is some reporting which needs to be done when it comes to a deferred arrangement. So very much possible that now you are able to actually, when you are setting up a entity, say example in Dubai, you can expressly have a document to state, look, I'm investing the company, the shares are being issued to me, payment will happen say within 6 months, 9 months, and do a reporting to the bank, and we'll look at the timelines of the reporting little later on, but yes, possible to do that reporting and then send the money subsequently. What was the situation under the old law? There was no clarity. So often you will come up with clients, etc., who would have set up a company overseas. They would have been doing businesses since last 3, 4, 5, 10 years, but have never sent a capital because there is no requirement under the host country law to receive a capital. Often you will see कि $10 में company बना दिया, but $10 भेजा ही नहीं, because and that country does not have an obligation. Like in India, your Companies Act, you cannot do a business unless you are filing a Form 20A, which means you have to mandatorily get the substantive memorandum within 180 days, right? Without which you cannot do a business. But foreign countries don't have those regulations. So I could just set up a company, not pay a capital and do a business. New regulation permitted subject to documentation and reporting. Old regulation, it was not possible. So a lot of cases are for compounding, wherein bankers are taking the position that this was not permitted, and hence you have to come for a compounding. What we say is definite period in the new regulation should be a definite period. Can I keep it 10 years? Law has not specified that, they have just said it should be a specified period. Can I keep it 10 years, 15 years? So law is silent on it, but bankers are taking a view that if it is up to 18 months, then it is okay. Beyond 18 months, then there are certain additional check and balances you need to ensure that, what is the commercial need to keep it beyond 18 months, what are documentation, what is a bona fide, and if a bank is convinced, they are permitting even beyond 18 months. And why this criteria of 18 months come by is because under a FDI regulation, you could have a deferred consideration for a maximum period of 18 months. So while FDI regulations specifically give it cannot be more than 18 months, overseas investment are silent. banker are drawing that interpretation that 18 months is okay. Beyond 18 months, we look on a case-to-case basis. So it is important this deferred consideration will also touch back when we are looking at further reporting requirements, the importance of this deferred consideration. We spoke about pricing guidelines, right? So anything that you do under a FEMA framework, whether it be an FDI or an ODI, has to be in compliant with the pricing guidelines, which means if you are acquiring a stake or you are transferring a stake, it should be at a price which is arrived on an arm's length basis. Again, the concept of tax comes by somewhere, transfer pricing comes by. You have to deal at an arm's length price. The law was little different, philosophically the same, wordings wise little different under the old law, wherein it said that if you are acquiring, you will acquire at a value not higher than the fair value. Which means if the fair value was say 100, I could have acquired at 80. Law today says I have to deal at the arm's length price. Arm's length price is say 100. Can I acquire at 80? No clear answers, but by and large the philosophy being the same should be possible. There could be questions about why the deviation, which you should explain, but then otherwise should be permissible to my mind. Whether FEMA RBI prescribes any valuation methodology that you should do a DCF or you should do a NAV, like income tax gives you a prescribed method to do it. Whether RBI comes back to say, RBI says no. RBI says any internationally accepted valuation methodology should be okay for getting a valuation report. If I am subscribing to Memorandum of Association, there is no requirement to get a valuation report. Now here there are some practical aspects not provided under the law, but practically that we come across, because what RBI has given the powers to the AD bank, that they will formulate their own policies when it comes to certain aspects, what is acceptable, what is not acceptable. So while RBI has given a broad philosophy, it should be at arm's length as per internationally accepted method, it has stayed away from giving a very detailed guidelines. It has left to the AD bankers to decide and formulate a policy. And AD bankers have policy which are varying across AD bankers. By and large, what they say is the valuation should not be more than 3 or a 6 month old, the valuation date. Typically should be based on audited accounts. These are some internal checks which the AD bank has kept, not necessarily coming through the regulations. Now, while we are speaking of the AD bank, we need to also understand the importance of the AD bank. So all your reportings, everything has to be routed through the AD bank. There is no direct communication per se with RBI. Everything is channelized through your AD bank. Your AD bank are sort of like an intermediary or a face between you and RBI, right? So how the concept of AD bank is working when it comes to an overseas framework. All your transactions in relation to a financial commitment in one foreign entity has to be routed through one designated AD bank. Which means, suppose if I have done an equity capital through AD bank 1, all my subsequent equity capital or a loan or a guarantee have to be routed through that particular AD bank only. Can I change an AD bank? Yes. There is a provision available wherein you can take a no objection certificate from the AD bank and move your entire overseas investment to another AD bank. Can I use it for a convenience? Ki bhai, there are some reportings pending with AD bank 1, let me move the UIN and do the investment through another AD bank? No. Banker will not permit a transfer of a ODI if there are any defaults which are pending or regularizations are pending. Suppose I invested into a UAE entity using a AD bank 1. Can I invest into another Singapore entity directly through a AD bank 2? Yes. The concept of AD bank is vis-a-vis one foreign entity. I can have a different AD bank for different foreign entities. Again, why this is relevant, why this is relevant? Because every foreign entity is allotted a unique identification number, a UIN. And that UIN is a foreign entity specific identification number. So anyone in India wants to do an investment into that foreign entity which has a unique identification number, RBI wants it to track, and for that it has kept one AD bank as the tracking agency. So all the transaction has to be done through that one AD bank. Suppose you are investing into an entity. Suppose Mr. A has invested through, say, AD Bank 1. I don't have an account with AD Bank 1. I have an account with AD Bank 2. Can I invest with AD Bank 2? No. You'll have to open an account with AD Bank 1 and do the transaction from that AD Bank. And there are a lot of defaults which have happened wherein unknowingly people have invested into a same entity with different bankers, which is a compounding issue then. So now let's understand what are the reportings that are required. When I'm actually making an initial investment, I have to submit Form FC to the bank, giving all the details, confirming rules, regulations, etc. When? At the time of sending the outward remittance or making a financial commitment, whichever is earlier. We relate it to the concept of a deferred consideration. I set up a UAE entity today. I will make the payment when the bank account is operational, maybe 6 months later on. When do I do the reporting? At the time when I made the financial commitment, which means at the time when I actually set up or signed the subscription to memorandum, not when I'm actually sending the money. And hence that deferred consideration comes into picture, because then there's a provision which enables it, and you have to do a reporting when I'm subscribed into memorandum, and then a subsequent reporting again when I'm actually sending the money. It is very important that lot of cases are happening wherein there is no timeline prescribed. See, what it says is, at the time of making a financial commitment or sending remittance, whichever is earlier. Remittance is easy because you are actually sending. So if you're an existing entity, you are sending money, it becomes very easy. What if you are setting up a company? At what point of time do I inform? So here there is a practical difficulty. Typically what you need to do is, before the entity is being incorporated, before you are signing the subscription to memorandum, you have to inform your AD bank saying that I am going to invest into that entity. These are the details, these are the permissible activity, this is the amount of capital, this is within my framework, etc. And do a reporting. Then the company gets incorporated. And then when the money is being sent, you do a reporting to convert this non-fund reporting into a fund-based reporting. Now often what happens is, there is a delay. And typically in overseas entity, the moment you give the documents, in a 1 or 2 days, you get the incorporation certificate. And what if you have not done the reporting? Then it is covered as a default and you need to pay a late submission fee. So it's very important that before the entity is being set up, all the documentation, everything is agreed with the banker, everything is filed formally, form is submitted, UIN is obtained, then you proceed with the incorporation. Otherwise you will be ending up with a late submission fee. We spoke of the UIN, so it's a unique identification and it will be quoted everywhere in all your compliance, etc. So you have a track. You also need to submit the evidence of getting the investment within 6 months, and that evidence could be a share certificate or it could be any other document which evidences that you have got the investment as per the host country law. You need to submit within 6 months. If you are not, there is again a default. Similarly, there is an annual filing compliance for an annual performance report, and here we'll like to spend some time. How much we have? 5-10 minutes. Okay. Okay. So on APR, important to understand that APR is required for each foreign entity. So if I'm invested in Singapore, I have invested in Dubai, I have invested in UK, I have invested in US, there'll be 4 APRs which will be required to be filed. The due date of filing the APR is 31st December. But if the accounting year of the foreign entity ends on 31st December, I can file the APR by 31st December of the next year. So example, suppose accounting year ends say on 30th June 2025. My due date is 31st December 25. If it ends, say 5th of April 2025, my due date is 31st December 2025. If it ends on 31st December 25, my due date is 31st December 26. Right? APR has to be certified by the statutory auditor in case of a entity and a chartered accountant in case of a individual. APR has to be based on the audited financial statement. Now here the entire UN cry is around. Because audited financial statement, getting an audit done in a foreign entity is prohibitively expensive as compared to in India. Earlier, bankers were accepting the special purpose financial statements prepared by Indian chartered accountants and APR based on that. Whether now they are accepting, so today the trend is that a Indian chartered accountant audited accounts are being accepted by the AD bank, but with a caveat that the audit report specifically mentions that audit has been done as per the host country law and regulations. Which means an Indian chartered accountant has to certify in his audit report that this is as per the host country law. Only then bankers are accepting it. Otherwise, you need to get the audit done from the CPA or the auditor which is recognized in the host country. Whether APR based on unaudited accounts is permitted, only situation is where the resident does not have a control and does not have a control, and I think there's something missing, which is also no financial commitment other than equity. And host country law do not mandate audit. So 3 conditions: I should not have a control, I should have a financial commitment only in equity, which means no debt, no guarantee, and host country law do not mandate audit. If I satisfy all 3 conditions, then based on unaudited is okay. And your APR is not only a report about your foreign entity, you also need to mention details of your step down subsidiary. You also need to mention the shareholding pattern changes of the foreign entity. Everything has to be reported in the APR. So while there is no express reporting for a step down, everything is subsumed within the reporting under the APR. Now question is, to whom the APR applies? Everyone? So no, APR applies for an overseas direct investment which is made by a resident, individual or entity. It does not apply if the resident is holding less than 10% without control and has made financial commitment only by way of equity. Again, control becomes relevant to decide whether a APR is required or not required. So if an entity has invested in an overseas entity only 1% stake, I don't have a control, then I don't need an APR. But if I have a control, then yes, APR is required. Second exception is foreign entity which is under liquidation. If 2 or more entities, persons have invested, then person with the highest stake has to do the APR filing. If jointly, then jointly. If equally, then jointly. So the onus is on one person, and again, this relates back to the relevance of one UIN, because one UIN captures all the information. So if a person A, which has the highest stake, has done the reporting, then there is no reporting required by the other entities. Similarly, you need to file the FLA returns by 15 July. Not applicable to a resident individual, only an Indian entity has to file it, which is now extended for this year up to 15 September. Right. Very quickly, on the OPI, so OPI, individuals don't have to do any reporting. Only an entity, listed and unlisted in certain case, have to do a OPI reporting within 60 days of a half-year period. For an ESOP, the reporting obligation is casted in case of an OPI on the Indian entity. Like, if the foreign entity is issuing to an employee or a director of the Indian entity, Indian branch office, what we saw, then that Indian entity has to do the reporting and not the individual person who is getting the ESOP in case of an OPI. Yeah. Very quickly, what happens if there is a delay? Yeah. See, anything which is not explicitly permitted, you can go to RBI. Whether RBI will permit or not, is the question. No, then RBI will lay down the conditions and you'll have to fulfill those conditions. So RBI will specify what can be done, what cannot be done, how much can be done. But there are a lot of leverage, etc. Those things come into picture. What happens if we miss on the reportings? Then, luckily, there is a late submission fee concept before the compounding really triggers. So compounding is actually more stringent. You are pleading, you are guilty, and regularizing a transaction. So late submission fee is a very good concept wherein small delays can be regularized by paying a late submission fee. What happens to our defaults which are under the old regulations? Reporting defaults under the old regulations. RBI has given a 3-year window which is coming to an end on 21st August 2025. So until 21st August 25, even if the APR for 2010 has not been filed, it can be filed under a late submission route. After that, you will have no choice but to go for a compounding. So it's very important that we look for all the past defaults in our clients and ensure that whatever is done under the old regulations, any reporting delays are regularized by 21st August 2025. For the investment under the new law, you have a 3-year window wherein you can apply for a late submission. If I am doing a default today, I have a 3-year window to regularize it. And yeah, it will be for the period, it will apply for that period, but you have an eligibility that you can do it. Then you go under compounding, so then compounding matrix will apply. No, so 3 year is only that whether you go under a late submission route or you go under a compounding route. So late submission is a facility which is like a lenient. You don't have to go to RBI. You just say there's a reporting default, standard formula, pay the late submission fee within 30 days, maximum up to 100% is levied, and you are done. If you don't, then you have to go for a compounding, which is much more elaborate process. No, so if you see, generally what happens is if you have done for a compounding, your compounding will not proceed unless you have regularized the default. So before your compounding application is heard, there's a declaration that you have to give, or RBI will, if not done, RBI will insist upon you regularizing the transaction and then coming to a compounding. So then you will have to do the filings, etc., and then go for a compounding. And then it will be covered under a compounding matrix. Right? So this is on account of the late submission, and it is important that all this is captured into a detailed project profile, a DPP. DPP is nothing but your ledger in the books of RBI. So all the reportings that you have done gets reflected over there. The day on which you have made a financial commitment, how much financial commitment you have made, when you have filed an APR, what is the date of submission, how many years you have filed, everything, all your history is there. And this you can get it from your AD bank. You'll have to request your AD bank to get the detailed project profile, and it will give, based on the UIN, and will give all the information which is relevant for you in that file. Right? So this is in relation to, so then we have covered even the reporting aspects, the compliance aspects also. Right? Very quickly, like 5 minutes, we'll close on the income tax. Income tax is something we all are very well versed with, but nevertheless, when it comes to a cross-border, we already spoke of Black Money Act in the morning about the disclosure requirements, etc. So yes, it has to be ensured that those are being reported. Tax implication on sale, etc. Because it's an Indian entity, Indian individual, capital gains, dividend income taxable in India. Host country law, you look at it, look at a treaty benefit, whether taxable in the host country. If yes, whether a tax has been withheld in that country, then you could look at claiming a foreign tax credit by way of filing a Form 67. Transfer pricing provisions apply in terms of applicability, determination of ALP, for filing Form 3CB, etc. Master file CBICR reportings will trigger, because then you are now an international group. So there is an added reporting for a master file, and CBICR, there are of course limits which are prescribed. POEM is an important factor which you need to take into consideration whenever Indian clients are actually going overseas for setting up an entity, because it's a very high exposure that you take if the control and management is in substance being done from India. And there could be a lot of tax consequences which could trigger by. Whenever you are doing under an LRS, you also need to be mindful. There will be a TCS that will apply, which is a significant amount. You need to take care in terms of your advanced tax calculations, and often, unfortunately, it may so happen that if you're claiming a very high refund, you could also expose yourself to an assessment. So, you'll have to be careful. Even that could become a triggering factor in deciding an individual or a entity mode of investment, particularly in case of ODI. And yeah, that's it. If there are any questions, happy to take it.
Niraj, I have one question.
Please.
So there is a resident individual, and resident individual is liquidating the amount in mutual fund and want to transfer those amount to non-resident. So what will be the procedure?
Non-resident as a gift.
Yes, as a gift.
So under LRS, this will cover both under LRS. So under an LRS, a resident individual can gift to a non-resident up to the LRS limit without any implication or repercussion. Now you could do it, but there are ways, that means people are bypassing this facility, right? Like they are gifting beyond the LRS limit, etc. So there is little lack of clarity whether I can give more than the LRS limit. Up to LRS limit, I think there is no problem. Beyond LRS limit, there is a issue.
And even this applies to if they want to transfer a flat.
So no, immovable property, there is an express restriction that a resident individual will not be able to gift a foreign property.
No, the flat is in India.
Flat in India.
Yeah.
Okay, flat in India, then you can gift it. Then there should not be a problem. Flat should not be a problem.
Sir, just this is not related to this, but about there is a talk of the town, or everyone is talking about Dubai Golden Visa.
Right.
So if you can tell about, I mean, it's already time, but
Yeah.
2 minutes.
So
You can cover in a panel also.
yeah, so Dubai Golden Visa is actually a lot of hype going on. But what really benefit you get after Dubai Golden Visa are more benefits in terms of you going to Dubai, taking properties, etc. Does it make you a non-resident? No. Does it change your citizenship? No. So it is like you have a US 10-year visa, you have a Dubai Golden Visa. It facilitates certain aspects, gives some concessions, etc. But beyond which, it is less limited. Right? Yeah. Right. Yeah. Hmm. Hmm. So if you have a investment outside India and that overseas entity is taking an investment from third party, very much possible. Yeah. So if you are investing into what which is doing an operational business in US. Yeah. No, so LLP or LLC, which is actually like a very recognized mode of doing business through an entity in US, it is an ODI, because if you look, your capital, perpetual capital, if it is treated as equity in that home country, it is actually a equity capital. And even a foreign entity definition includes a definition, you should have a limited liability, so which includes your LLC also. No, so you are saying that LLC does not issue any capital or does not issue any instrument? Investment. Not voting, but they still have that capital stake. They still have the capital stake. But again, you need to see whether then it's a financial service activity, then you need to ensure that other conditions are complied with. Yes, yes. So if it is a OPI listed, then under LRS you have a 180-day window. Under an ODI, you have to get within 90 days. So if hypothetically, if I'm getting a dividend from an ODI investment, I have to get back to India within 90 days. But if it's a listed, I have that 180-day period to either retain, reinvest, or bring back to India. That no, it will. You are eligible to invest. No, it will not be counted. Yeah.
Can we take it offline?
Yeah. Let's not stand before lunch.